Hi, and welcome back to the Food Fund, where we analyze investing in food stocks, beverage stocks, and restaurant stocks. If you are new here, our goal is to help you put your money where your mouth is and invest in the best food companies. Is the world's oat milk habit a good investment? You might be surprised by the answer. In this video we will be analyzing if Oatly stock is a buy. Could Oatly, stock ticker symbol OTLY, be the next big player in the stock market? Let's find out. We have a lot to cover, so let's go ahead and jump right in. Cue the logo. Let's start with some background info on Oatly. Oatly was founded in 1994 at Lund University in Sweden. Researchers there were looking for ways to harness the power of oats, and Oatly was born. Their headquarters are still in Malmö, Sweden, keeping those Nordic roots strong. In addition to oat milk, Oatly offers a whole range of oat-based alternatives to dairy products. We're talking oat yogurts, spreads, and even cooking creams. After the initial public offering, or IPO, in 2021 and the appointment of a new CEO in 2023, Oatly has been moving towards profitability. Today, Oatly remains a leader in this plant-based space, employing over 1,500 workers. Now let's look at the price action. Starting with the 1-year chart, we see that Oatly had a CAGR of about -53%. Zooming out to the 5-year chart, we see that Oatly had a CAGR of -66%. Oatly's share price has been in a near constant decline. This has been very painful for shareholders. If we perform a backtest comparison of investing $10,000 in Oatly versus the S&P 500, we find some poor results for Oatly. In that comparison with the S&P 500, $10,000 invested in Oatly would have shrunk to $468 or a -67% CAGR versus $12,607 or a 9% CAGR if invested in the S&P 500. You read that correctly. A $10,000 investment in Oatly would have turned into just $468. This demonstrates tremendous underperformance for Oatly. An Oatly investment would have also been more volatile with a 89% standard deviation versus 18% for the S&P 500. Oatly underperformed the S&P 500 in terms of the best year performance, for which Oatly actually fell 6% versus S&P 500 26% gain, and worst year performance where Oatly fell 78% versus the S&P 500 18% fall. In terms of max drawdown, Oatly fell 98%, more than 4 times the max drawdown of 24% for the S&P 500. And surprisingly, Oatly did underperform the S&P 500 in comparisons using the Sharpe ratio and the Sortino ratio. Whoa, just awful price performance. Now let's hop over to market share and take a look at Oatly's market share. Here we have the dashboard, where we can quickly gather a lot of information at a glance. Expanding the dashboard, we can look under beverage and see that Oatly is categorized under non-alcoholic beverages. Expanding the non-alcoholic beverages tab, we can see that Oatly has a very small market share but is growing. Let's look closer at the year-by-year changes in market share. So we come down here and type in the ticker symbol for Oatly, OTLY, and see that the market share is just 0.08% out of the publicly traded food, beverage, and restaurant stocks currently in the market. However, Oatly is growing market share. The 5-year market share CAGR for Oatly is 30.59%. If we start in 2019, we see that the market share was 0.028%, 0.059% in 2020, 0.077% in 2021, 0.078% in 2022. And rose to 0.082% over the trailing 12 months. In this newest version of market share, all of the companies are already grouped by industry, so we can see that Oatly is growing slightly faster among beverage companies with 5-year market share CAGR of 30.69% than among publicly traded food, beverage, and restaurant stocks combined. This means that Oatly is growing market share on both an industry-specific and absolute basis. This is great news. Let's take a look at the fundamentals. Gross margin is 19%. This is much lower than other beverage companies. Revenue has compounded at around 40% over the past 5 years and has reached over $783 million most recently. Oatly really does have product market fit. Now if they could just get these costs under control. Looking at cash flow, we see a minus 43% CAGR over the last 5 years for operating cash flow, while capex has worsened at a 5% CAGR. As a result, free cash flow has worsened at a 26% CAGR. Operating cash flow is slowly improving, and when combined with Oatly's move to a capital-light strategy, free cash flow is also improving. I think capex is about as cheap as we can expect over the next few years, so getting to positive operating cash flow will be key. Weighted average shares outstanding have risen over the last 5 years, going from 407.3 million shares in 2019 to 593.6 million shares most recently. Oatly has been diluting shareholders. In fact, the rate of shareholder dilution is almost 10% per year. While the dilution rate has slowed in recent years, I expect dilution to continue at least until free cash flow positivity is achieved. Now let's view return on invested capital. Return on invested capital has fallen from minus 11.1% in 2020 to minus 47.6% in 2023. This is not good. Essentially, this means that Oatly continues to invest in its business but has not generated any income from those investments. In fact, losses at the company continue to worsen. Another favorite metric is cash conversion cycle, a measure of operational efficiency regarding supplier and payer leverage as well as inventory control. Going from 47 days in 2020 to 57 days most recently, Oatly has gotten less efficient over time. The good news is that this value has been improving since 2022 and will hopefully continue. Last, let's look at Oatly's debt. The net debt to EBITDA has increased just slightly over the past 5 years, going from minus 3.4 in 2019 to minus 0.7 most recently. With the company being unprofitable, no fundamental improvement can really be inferred. The company needs to become profitable. The fundamentals of Oatly are improving very slowly. In any event, should it be added to the portfolio? Before sharing my final thoughts on that, please click the like button and let YouTube know that you like the content. Subscribe and click the notification bell to make sure you catch the latest videos. We are on track to hit 1000 subscribers this year, so thank you for watching and consider subscribing if you have not yet done so. Your continued support means so much to the Food Fund. Now, let's get into my final thoughts. Okay, let's go to the spreadsheet and write out some key values for Oatly. It is a beverage company with a gross margin of 19%. The 5-year revenue per share CAGR is 27% and the 5-year free cash flow per share CAGR is minus 14%. Small gross margin but good revenue growth with contracting free cash flow. Again, growth is not Oatly's problem. Expanding margins and growing free cash flow is the challenge. A return on invested capital of minus 48% is horrible and worsening. Next, the cash conversion cycle of 57 days is bad but is starting to improve. Concerning debt, a net debt to EBITDA of minus 0.7 means that Oatly is unprofitable and carries debt. Now let's switch our attention over to valuation. Oatly is negatively valued relative to the S&P 500 with a ratio of minus 0.05. The price to earnings growth, or PEG ratio, cannot be calculated because the company is unprofitable. Oatly continues to be a growing company in terms of revenue and market share. There is no doubt that more and more customers love the product. The big problem for the company is rising costs. If we look at a chart of cost of goods sold, total operating expenses, and capex, we find some important insights. Cost of goods sold is Oatly's largest expense and primarily consists of oats. Cost of goods sold has increased at a 46% CAGR, outpacing revenue's 40% CAGR growth. This has caused gross margin contraction but seems to be improving, with 2023 cost of goods sold of $631 million representing a 2% decrease from 2022. This is good news. I expect this trend to continue. As stated earlier, capex is decreasing at a 5% CAGR. However, capex spend has slowed tremendously, going from $274 million in 2021 to $66 million in 2023. The real culprit in spending is the operating expenses rising at a 58% CAGR. while research and development account for a relatively small proportion of operating costs. Selling general and administrative costs is where management should be focusing their efforts. And to their credit, they have reduced selling general and administrative costs in recent quarters. Oatly is on the path to the promised land of profitability, but there are still risks. Rising oat prices, revenue and market share contraction, and massive shareholder dilution could derail the improving fundamentals. However, for those with a risk appetite, Oatly may represent an attractive buy at these levels due to its increasingly favorable risk-reward ratio. For me, Oatly is going on the watch list as the future for the company is becoming more clear. Many thanks for watching. What do you think about Oatly and their cost reduction? Please share your thoughts below. It is always great to hear from you. Please check out some more videos right now and don't forget to put your money where your mouth is.